Welcome to Talking Property. The property market will start 2017 in great shape. The Sydney market's been rising for 5 calendar years in a row now, and for most of that time apartments have performed equally as strong as houses. But in the second half of 2016, the apartment market began to underperform the housing market. Concerns about oversupply and Chinese buyers defaulting en masse shook the market, and only time will tell whether this was yet another scare campaign sweeping through the market or a structural change that will see lower apartment prices. 2017 promises to be a busy year for baby boomers. The first of the boomers turned 70 in 2016, and we'll see an increase in baby boomers selling the family residence, competing strongly for luxury apartments and selling off their investment properties to fund retirement. The changing property needs of baby boomers has been largely overlooked to date, and given the large representation of baby boomers in the property market, their impact on the market's fortunes cannot be understated. When it comes to interest rates, late in the year we saw the retail banks begin to increase home loan rates independent of the RBA. This was an unexpected move, but has had minimal impact on the property market thus far. Needless to say, the property market doesn't like rate rises of any kind. Housing stock has been tight for nearly 12 months now, causing headaches for home buyers and windfalls for sellers. To discuss this and more, today is my guest, Louis Christopher from SQM Research. Louis, welcome.
Good to be here, Peter.
Louis, what does the 2017 Sydney property market hold?
Well, I think you've summed it up very well. I think it's going to be a strong market overall for Sydney, as strong as what we saw in the second half of 2016. So the present trends of very high auction clearance rates, low listings, particular strength in the city's inner ring will continue at least for the first half of the year.
So just defining that for our viewers, what did the property market do in the second half of 2016, given that's what you expect to see happen in 2017?
Well, in terms of price gains, we believe the market was rising at a tempo of something like circa 15% per annum. It was very, very strong, particularly in the inner ring. The outer ring for most of the year was actually weak, very flat, particularly in the northwest, where we've seen a lot of house and land packages enter the market all at once. But towards the end of the third quarter, so towards the end of September, basically all of Sydney started to accelerate with the inner ring really recording strong rises. I've got examples of properties basically reselling in the market at about a 15 to 20% rise in just a few months in Sydney's inner ring. So it was quite extraordinary, the price gains, and it happened as a result of hardly any sellers in the market during a time when seasonally you see more sellers and too many buyers.
The spring market never really came this year in 2016, did it?
No, it didn't. That's a very abnormal situation to have. Normally, every spring we see a seasonal rise in listings as many sellers want to basically change their affairs or close their affairs off before Christmas. And we didn't get it this time around. And I think the reason why we didn't get it was that many sellers were actually fearful of not being able to find a property to re-enter back into the market again. So they were holding off because of that particular issue. And in the meantime, there was this pent-up demand of buyers who did sell, many of them did sell, say, during winter, thinking they'd easily be able to get in during spring, and they couldn't get back in.
That's definitely what we saw on the ground too, Louis. Now, you've said 15% growth to finish off 2016, which we also saw on the ground.
Yeah.
That's phenomenal growth at the back end of a boom, but you think that's going to continue?
Yes, that's right. And the reason why we think it's going to continue is because we do not see any triggers at this point in time to create a slowdown. You did mention in your introduction that, look, there's been some rises in interest rates, but they've predominantly been at the fixed end of the marketplace.
Correct.
Fixed interest rates have gone up, but at the long end as well. So like a 5-year fixed rate has definitely gone up. But when you look at the variable interest rate and the short-term fixed, there's been no movement there at all. And most borrowers are generally at the short end of the market. So we haven't seen a big impact, particularly the owner-occupier market as well, where interest rates have not gone up, most interest rates where they've gone up at the long end has been for property investors per se.
And is there any suburbs in particular in the inner west that you're seeing perform more strongly than others?
Oh, gee, nearly all suburbs. It's really hard to define one individual suburb over the other in the inner ring because they've all been firing along. Balmain, Leichhardt, all those type of suburbs, Alexandria, they've all done extraordinarily well. The only issue with all this, though, Peter, is that the market is now becoming quite overvalued. On our numbers, we believe the market is now 40% overvalued, and that means that the market is susceptible to any type of trigger that may well come along in 2017. We don't think it's going to come along. We don't think the RBA is going to lift rates next year, but potentially in 2018 there could be a downturn.
Yeah, sure. Glebe's another suburb that we saw in 2016 experience phenomenal growth too, Louis. I'm not sure if your numbers showed that, but some of the sales that I saw through Glebe this year were particularly strong for what it's worth, yeah.
Well, you've done well, Peter, because when we look at Glebe listings, there was hardly any listings in the marketplace. And so, yes, it's been very much a strong seller's market for Glebe. Many buyers, hardly any sellers. A typical trend that we've seen for a number of suburbs, actually, where very tight listings have driven up prices big time.
Yeah, great. And Louis, will all these new apartments that have been built around Sydney, and that includes broader Sydney as well, will that act as a drag on the rental market? That's what I'm keen to know.
Well, rents last 12 months did slow a little. Basically, we're recording rental rises of about 2 to 3% across Sydney. Some areas it's been flat, so out in Sydney's northwest, we've been recording some elevated vacancies in the 2.5 percentile mark, and that's meant that rents have pretty much done nothing there. Once again, in the inner ring, we have seen rental increases, but nothing too dramatic. You know, it's once again, it's low single digits. With the apartment side, I don't think that's the reason why we've seen a slowdown yet, because that major increase in completions of apartments hasn't quite arrived yet. Yes,
Right.
there's been an increase in completions, but the absolute peak won't actually happen until 2018.
So is that a threat to the market coming up that investors should keep an eye on?
It will be a threat in certain pockets.
Yes.
The reality is that we're not having a massive oversupply of apartments across Sydney per se. It's only in certain locations where we're seeing this potential risk in the marketplace.
Yeah, great. Now, you mentioned that Sydney was overpriced. Is in this environment of cheap, easy money across the globe, is Sydney overpriced from a global perspective?
Yes, Sydney is actually overpriced from a global perspective as well. So, you know, when we look at, say, comparable cities to Sydney, such as New York, such as London, such as Paris, such as Tokyo, look, these markets, relatively speaking, are a little bit more, offering a little bit more value than what Sydney is right now. But just because perhaps a city is overvalued doesn't mean that you're going to have an imminent correction or a major crash.
And that's the bit that the commentarians seem to be missing, right?
Yeah, that's right. The general view is, okay, Sydney housing market, Melbourne housing market is massively overvalued, therefore crash is about to be upon us. Well, no. You may well see markets continue to be overvalued and they continue to run because they don't suffer from the trigger. They don't actually have a trigger to create that next downturn, or the underlying dynamics of those markets to make them overvalued in the first place are still there, such as strong population growth, such as hardly any new supply coming into the marketplace, such as prosperous cities becoming even more prosperous.
Yeah, great. And you touched on it, but just expand if you can. How does the retail banks raising interest rates, how's that likely to impact on the market next year?
Well, if the retail banks were to lift the cash rate, or the Reserve Bank of Australia lifted the cash rate, so that would mean variable rates would actually rise. That would have an impact upon the marketplace.
So you're not in your forecast of 15%, correct me if I'm wrong, but you're not factoring interest rate rises there. So if we do see an interest rate rise in 2017, do you revise your forecast on what the market's likely to do?
Depends on the timing of such a scenario.
Let's say mid-year.
Mid-year, yeah, that would slow down the housing market in the second half of the year.
Okay.
So We don't think, though, a rate rise will come next year, especially when we have a situation where the economy's just recorded negative growth, where we're not really getting very strong employment numbers, where the retail side of the economy isn't that strong as well. I think it's unlikely rates will rise next year, but 2018 we may well get a rise, and that's why we've been putting out commentary out there to suggest that, watch out for 2018. That could be the year where we get the downturn.
Right, good advice. And for our viewers who are interested in investing, Louis, Sydney and Melbourne has experienced phenomenal growth over the last 5 years and look fully priced to overpriced, as you've said. What cities in Australia outside of Sydney and Melbourne should investors look at from an investment perspective?
Well, we've been more positive on regional areas such as the Gold Coast and Hobart, where there has been a recovery occur in both those two minor cities, and we think that will continue on for at least the next 2 years. Both those cities are enjoying the lower Australian dollar. They're definitely very Australian dollar
From an
sensitive.
agriculture and tourism perspective?
Absolutely, particularly for the Gold Coast, it's more tourism orientated.
And agriculture.
Hobart is a combination of both.
Yes.
They generally suffer when you see strong Australian dollars, so between 2010 to 2012, when the Aussie dollar at one stage was over $1 US, these two cities really did suffer, and there was quite a correction in the marketplace.
Louis, I've always felt that the impact of the Australian dollar on the housing market is largely underrated. Would you agree with that?
I think for the major capital cities such as Sydney and Melbourne, there's less of an impact. But for other cities, there can certainly be a greater impact. I've just mentioned the impact from the high Australian dollar on areas such as the Gold Coast and Hobart. In Perth, look, there's a multitude of factors there, such as commodity prices. But no question, the Australian dollar also has an impact there as well. And with the lower Australian dollar, that's helped buffer what could have been a very nasty downturn in Perth. As it was, the market has been correcting, with the rental market really coming off by about 11%.
So
but it could have actually been worse if we still had a dollar parity with the US dollar.
Put Perth into outright depression.
Correct.
I note that even though prices have crashed in Perth, you're still not sending investors to the Golden West.
No, we're still being cautious about Perth. We think there'll be another year of falling prices, but we think this could be the last year in 2017. We have noted that for a number of commodities, it seems as though there's been a bottoming occurring, and the Reserve Bank of Australia has noted a little bit of an uptick actually in some key commodities.
So in summary, East Coast to peak in 2017 and the West Coast to possibly bottom in 2017.
With the Gold Coast and Hobart continuing to do well right throughout the whole year.
So, Louis, any final words of wisdom for property buyers and sellers for 2017?
Well, overall in 2017, I think for Sydney and Melbourne, it will remain a strong seller's market. Potentially, we could see a slowdown in the last quarter of 2017, brought upon by new fears of apartment oversupply, potentially APRA stepping into the market to restrict borrowing again. I think for other cities, we're still quite positive on Hobart and the Gold Coast because of the lower Australian dollar and surging economies in both those cities. And we do believe that finally Perth and Darwin will actually bottom out in 2017 after what's been about a 4 to 5 year downturn. Brisbane, the last city, we think it'll continue on at very low single digit growth. We still have an oversupply issue in the Brisbane CBD, namely apartments. That's already with us, has actually been with us for the last 2 years. So that'll keep a lid on capital growth in Brisbane for next year.
Fantastic. Louis, excellent information today, and thank you for sharing it with our viewers.
Thank you, Peter.
We're delighted to have Louis join us each and every quarter to update us on the property market. He's by far Australia's best property analyst, and I hope that you've taken something out of our chat with Louis today. Thanks again.